I will need to start the next topic, which is inventory valuation. I think we are left behind now. Those are the things that we need to work on going forward. But thank you so much for joining. I'm sharing my screen now. I hope you guys can see the screen. I have a question paper here. This is June 2025. I just want us to discuss a few things here that are related to the financial indicators where we're interpreting the information, looking at the financial indicators provided. Okay. This is question 3, interpretation of financial information. We know what is more important as a grade 12 student. We have to be able to interpret the financial indicators that are provided. Not only that, obviously, there may be some calculation here and there. We may also have to calculate some ratios. We may also have to answer some other questions, internal control questions, but most importantly, from these 40 marks, a majority of them is coming from the financial indicators. Okay, so it's very important because 40 marks is a lot for this question, and it is going to cover a lot of marks for you to pass. Okay, so this is Venus Ltd, the company that we're working on. So here I have a spreadsheet where we're going to answer the question. Okay, and then here I have our note that we worked on the analysis and interpretation of financial statements. You remember we spoke about profitability, we spoke about the liquidity, we spoke about solvency. We just need to know the description. Like when I'm talking about profitability, what is that I'm actually talking about, and what is the description that we have under profitability, liquidity as well. When I'm talking about liquidity, I know that I'm looking at the ability of a company to pay off its immediate or short-term debt, right? We must know when we talk about return, what is that we're looking at? When we're talking about the financial risk or gearing, what is that we're looking at? Very important for you to answer the financial indicators question, okay? Venus Ltd. So what they're saying here, the information relates to Venus Ltd for the financial year ended 28 February 2025, right? So this is our financial year ending 28 February 2025. I would like to know when is it starting? If it ends 28 February 2025, when is it going to start? When is it going to start, this one?
The 1st of May 2024.
1 March 2024, right? Thank you on that. Sorry? Yes, come again?
I think I said May by mistake.
Oh, I had that. I thought you were saying March. It's fine. 1 March 2025, yeah, 2024, that is our starting point, and then we're ending 28 February 2025. In some other topics, the financial year may not be that important. For example, this topic, we're not paying attention that much to the financial year end, but for me, I believe that whichever question we're working on, it's very important that you understand your accounting period, because it is going to help you in terms of answering your questions, okay? Background information, let's look at the information provided. Very important, guys, that whenever we're reading the information, you understand what the information is provided, because the questions will be answered based on the information provided. So if you don't understand the background information of the company and other information provided to help you answer the question, it will be difficult for us to answer those questions. So I believe it is more important to understand the scenario or to understand the information provided than understanding the question, right? Understanding the question alone is not enough, right? You also need to understand the information provided. So here, they saying here, Denzel Cross was appointed as the chief financial officer, right? On the 2-year contract, which will be reviewed on 31 August 2025, right? He is also a shareholder in Venus Ltd. So this is a CFO. A CFO, that is a chief financial officer, right? CFO is a chief financial officer. It is actually one of the executive directors, because if you are CFO, you are actually a director, an executive director. So that is Denzel Cross, who was appointed as a CFO on a 2-year contract, which will be reviewed on the 31st of August, 2020, 2025. When is 31st of August, 2025? It falls within the next accounting period, indicating that within the current financial year, we're having Denzel as our CFO. The full year in the current financial year, we're having him, Denzel Cross, as what? As our CFO, right? Then they're saying here, note, where comments or explanations are required, you should quote financial indicators and then trends with figures. Very important, because we're comparing 2 years here. We want to check whether the company is improving or it is not improving, right? For you to see whether you're improving or not, you need to compare 2 things here, your previous performance and your current performance, right? That's what we're actually looking at. So when they're saying quote financial indicators and trends, you can quote a financial indicator, but without a trend, you cannot identify whether there is an improvement or not. So you need to indicate the trend, the increase or the decrease, the improvement or the deterioration. That's when you will know whether we're improving or not, right? Give a reason or an explanation for the financial indicators quoted, right? Once you have quoted a financial indicator and a trend, then you just give a reason for that. Or just an explanation for the financial indicator. You know very well how we were doing this thing here, right? We were quoting the financial indicators, right? We're just quoting the financial indicators. And then after that, we are able to give a reason or give some explanation to indicate to those who will be marking your exam to say, you do understand what is the meaning of the ratio. Because if you don't understand what does the ratio mean, there's no way that you can explain it. Okay, information. Let's look at the information now that we have here before we're looking on. Here we're going to have this 3.1 first, and then see how we go, what we're going to do after that. Okay, 3.1. Choose the correct word from those given in brackets. Write only the word next to question numbers 3.1.1 to 3.1.3 in the answer book. So this is just the warm-up questions, guys. Each and every question that we have, it does have these type of questions just for you to warm up before you deal with the real question. This is just 3 questions for you to warm up. It's a free 3 marks, actually. They're trying to give you free 3 marks that you need to collect as a grade 12 student. 3.1.1, effective control of expenses in the business is a reflection of risk or profitability. Which one are we choosing here? And I would like to know why you choose that. Effective control of expenses in the business is a reflection of risk or profitability. Kinelwe, what are you choosing here?
Profitability.
Why are you saying that?
Because if you use too much, if you have too much expenses, then your profits will be low, I guess.
Yes, that's correct. That's correct. If you are able to control your expenses, right? If you are able to control your expenses, definitely you're going to be profitable. That business will be profitable without a doubt. Each and every business, they must be able to control their expenses. A business with no effective control over expenses, they will make unnecessary losses, right? If everyone who wants to buy something in a business, they just do as they wish, then we have no proper controls over those expenses, then we cannot be able to manage the expenses, and therefore the business cannot be profitable. So this one, effective control of expenses in the business, is a reflection of what? Of profitability. So 3.1.1, I'm going to say profitability. Okay. That is number 1. So number 2, this one is for you, Smanga. Let's go through it. 3.1.2. When a company is liquidated, the shareholders' liability will be limited or unlimited, as they will not be held responsible for a company debt. What can you say about this one, Smanga? Which one are we choosing here? Limited or unlimited? They're saying here, when a company is liquidated, the shareholders' liability will be limited or unlimited, as they will not be held responsible for a company debt.
Limited.
it will be limited. Okay, why are we saying limited?
Because like Bashirula would say they will not be held responsible for the company's debts. So that's limited liability because then the possessions or assets will not be touched by Data Company.
Exactly, very good on that. If it's a company, right? If it's a company, remember we have different types of entities, right? We have different types of entities. We have a company, we have sole trader, we have a partnership, right? We have a partnership. So all these companies, in terms of the liabilities, it's different in how we deal. Even the companies, we have different types of companies: public companies, private companies, personal liability company. So companies, most likely, we know very well that a company has a limited liability, which means now if the company is owing and the company is liquidated, only the assets of the company, right? Only the assets of the company can be divided and used to pay the creditors or the liability of the companies. Otherwise, no one can touch the assets of the shareholders. Very good on that. So that is going to be limited. Okay. Number 3, let's go to number 3, which is yours, Kinelwe. Solvency or liquidity is the ability of the business to pay off all its debt using existing assets. What can you say about this one?
Liquidity, solvency. I'm not sure. I think I'll go with solvency.
Why are you saying solvency? You're not sure?
Because isn't liquidity like short-term debts? I don't know.
No, you're correct. It's just that you don't have confidence on what you're saying, but you're 100% correct. Yes, liquidity only deals with short-term debts, right? Which is correct. Very good on that. Now, when we start talking about all, because this question is more of about all debtors, right? All its debt. It's not only about the short-term debts, but we're talking about both long-term and short-term debt. Even like the solvency ratio. Do you know how to calculate a solvency ratio? Solvency ratio, it talks about total debt. Total asset is to total liabilities. That is solvency ratio, right? That is the formula for a solvency ratio. So that one is very important. What you're saying is correct. So the answer here, it should be solvency, not liquidity, because liquidity is only the ability of the business to pay short-term debt. This one is about paying all debt using what? Using the existing asset. So that is total asset is to total liability. That is solvency, right? Solvency ratio is equal to total asset is to total liability. Okay. The reason why I'm asking you guys to provide the reason is because I don't want you to guess. I want you to tell me something that you understand, right? That you can back up. Otherwise, saying limited and you don't know why, it means you're guessing. You don't know the answer actually, right? Thank you on that. Thanks very much for that, guys. But we have solvents there. Now let's go to 3.2. Okay, but now we just gonna go straight to all the questions and then we start looking at the information as well, because for us to answer these questions, we need the information. Okay. 3.2, they're saying here it's about liquidity. Definitely, you guys you are very sharp when it comes to liquidity. It's something that we did in detail. The previous sessions we've been looking on liquidity only, so you understand very well all the ratios that falls under liquidity. You know what is that, and even interpreting those ratios, we understand. Okay, so what is the question under 3.2? They're saying here the liquidity position of the company has improved. Quote 2 financial indicators with figures to support this statement. So we understand that there was an improvement on the liquidity, but we need to go and quote 2 financial indicators, only 2. There's a lot of them that we have worked on before, but we only need 2 here. Okay, I think these are frameworks that we're going to collect. 3.3, dividends payout policy. So we're looking at the dividends per share here, how much we're paying dividends based on the earnings of the company. So the question is saying here, calculate the dividends payout rate for the year ended 28 February 2025, right? Dividend payout rate. We don't have, from the formulas that we worked on for ratios, we don't have an exact formula for a dividend payout rate. But actually, we're trying to look at how much we paid from the earnings, right? We need to look at the earnings per share, and then we need to look at the dividends per share here. And then we calculate that rate, which is a percentage. So we're going to take dividends per share over earnings per share multiplied by 100. That is the payout rate that we're going to get to calculate for this one. So it's a very easy calculation. We're going to look at the information and we are going to do that calculation. Explain why directors decided to change the policy. Give one reason for that. So now here you can see we're talking about dividend payout policy. It means now we're going to compare the dividends paid in the previous year to the dividends paid in the current year and check what was the change. Did they decrease or did they increase? If they increased, it's still a change in policy. If they decrease the dividends paid, it's still a change in policy. So you just need to tell your teachers here to say, why did they decrease dividends paid or why did they increase dividends paid? You just need to explain the reason for that. There will always be a reason for decreasing dividends. There will always be a reason for increasing dividends you're paying to your shareholders. You just need to tell us, if I increase dividends that I'm paying to my shareholders, there should be a reason for that, right? That's what we need to explain. 3.4. Percentage shareholding and repurchase decision making, right? So now we are you see all these financial indicators, they falling within these categories. You can see now we're talking about a return. Are the shareholders earning a fair amount on their investment? We're not on profitability, we're not on liquidity, we're not on solvency, we're not even on financial risk scaling, but we are here on the return. So you must know very well all the ratios that falls within this category. So what is the question here? Calculate the number of new shares that Denzel purchased on day 1 July 2024, which means this Denzel, who is Denzel here? Denzel is it not that guy who is a CFO, who is also a director? I think that is Denzel. Yes, is that guy who is also a CFO, which means he bought some shares. We need to calculate how many, the number of new shares that he purchased. That's a very easy question, 4 marks for free. You cannot fail to do the calculation of the number of shares, guys, please. We can't do that. Next, calculate Denzel's percentage shareholding on 28 February 2025. The percentage shareholding. So we need to know the percentage of his shareholding, of which I believe this one also should be the easy question. Free 7 marks. You can see here these free marks to collect. The independent auditor discovered that Denzel had made the decision to repurchase the shares from the estate of a deceased relative, right, on 1 December 2024, without informing the board of directors. Okay, why should the independent auditor be concerned about this? Give one reason for this. So now we here in this question we go, is it the right thing to just buy shares of an estate? But remember, this one is a CFO. There's something that we spoke about, which was an insider trading. I'm not sure if I did speak about that with you guys, which is an insider trading. When we're doing directors and the audit reports and all of that, we did speak about something like that, having inside information that you're using, and others, they don't have, they're not aware of that information. And when you're using that information for your own benefit, it's not the right thing to do. But it's independent auditors here, they are concerned about that. They may be concerned about that. So we need to explain why they should be concerned about that. 2 marks. Anything that you can say to me, it is going to give us 2 marks. Okay, 3.5. Gearing and risk. Okay, now we shifting now to financial risk gearing. We must know the financial indicators that falls within there. Debt equity ratio, total return on total capital employed. These are the ratios that falls. To what extent the company is financed by loans, borrowed money compared to its own capital. So here we are actually comparing the capital, whether it comes from debt or equity. Remember, for the company to start, you have two options here. It's either you issue shares or you borrow money, right? But the aim is to make sure that we have less borrowed capital and we have more of equity capital, which is like money that comes from our shareholders. That is an intention for all companies to say, let us not borrow more money. Let's rather issue shares, right? So that we know very well that we don't have a risk of paying interest. Instead, we just have money that comes from our shareholders. Then we have less risk on the loans that we borrow. So let's see what are the questions here. You see, guys, the things that I'm talking about here, these are the things you need to think about while you're going through your required. Think about all these things so that it's easy for you to answer the questions because you're thinking about important information. Okay, the directors of Venus Ltd want to expand the business by opening one more branches in other provinces, right? Explain why you will recommend that they should not borrow more money, right? They should not borrow more money. Quote two financial indicators with figures, right? Why are we saying they should not borrow more money, right? And we know very well that when you're talking about, when we're quoting financial indicators, we have two, debt equity ratio, we have what? A percentage return, right? Sometimes we talk about the interest rate, sorry. But here we do have financial indicators. There's no way you cannot quote these two. You must talk about them in terms of advising them whether should they borrow more money or not. Okay. The other option of financing the proposed expansion is to issue more shares. Explain how this will benefit the company. Provide 2 points. We are now saying it's better to issue shares than borrowing money. Obviously, that is supposed to be having some benefit. We just need to give those benefits. Why is it good for the company to issue shares than borrowing money? One of them, I told you, we're avoiding the risk of paying interest. Because if you decrease money borrowed, instead using money from your shareholders, you're not going to be charged interest and all of those things. So it should be one of the reasons why we prefer issuing shares than borrowing money, right? Okay, share value. Share value. Okay, explain why here when we talk about share value, we're talking about share price here, guys. We're talking about the share price, things that improve the share price, things that make the share price to decline, to go down. You will remember very well, like there was a scenario we spoke about. I remember I was with you guys when we said like a day after, like, I think share price was about 100 and something. And then directors did something. And then a day after, the share price went down to about 15 rands. So that is a share value. Those are the things now we need to think about. Okay, they're saying here, explain why the shareholders should not be satisfied with the share prices of the company at the end of the financial year. Code to financial indicators and other relevant data. They are not happy with the share price. Obviously, there will always be a reason for a share price to drop. Share price just does not just drop, but there will always be a reason for that. So it's something that we're going to be looking at from the information provided, because they're saying here code to relevant financial indicators and other related data. We're going to check that data from the information provided. Renewal of CFO's contract. Now we talk about the guy who he was a CFO who also bought some shares in the company. He's a CFO, is also a shareholder. Explain why one reason why any company should appoint a suitably qualified person as their CFO. It's very important. CFO, remember, is someone who is handling financial matters of the company. That is the CFO, is the head of department of the finance department, right? Is the head of the finance department. That is CFO, Chief Financial Indicator. Everything about monies of the business. He's the one who knows all those things. Okay. Number two, apart from the factors and financial indicators covered in question 3.2, to 3.6. Quote and explain 2 financial indicators why you feel that Denzel's contract should not be renewed. Obviously, there must be something bad, which means he's not in control of the business's financial matters, of the company's financial matters. Then why should we keep a CFO like that who is unable to do his job properly? He must go if he has to, right? We're not hiring a CFO to maybe for like the feelings, to making sure that he's happy and all of that. No, work is work, guys. It doesn't have to consider feelings of people, feelings of employees. Obviously, it's very important to make sure that your employees are happy. But when the employee is not doing work we hired them to do, then they must leave, right? They must leave. So for the company to grow. Information, financial indicators calculated, we can see here we do have percentage operating expenses on sales, 18%, 22.7%. OPEX on sales, it has went down from 22% to 18%. Current ratio, it moved from 0.3 to 1 to 1.6 to 1. Is this good or bad, guys, according to your view? This movement on the current ratio, is it a good movement or a bad movement? What can you say about this one?
Good.
It is good. Why are you saying that?
Because it has increased from 0.3 to 1.6.
Exactly. This is an improvement. What does this improvement mean? Like, what does it actually mean?
That we will be able to cover up our short-term, we'd be able to cover up our short-term debts.
In the current year, ne?
Yeah.
In the previous year, did we manage to do that?
No.
Yes, we were unable, exactly. Last year, we were unable to meet our short-term obligations, but now we are able to. So it's an improvement, right? And in here, we have an acid test ratio. Acid test ratio is 0.1:1, and then it moved to 0.8:1. So what about the acid test ratio? What can you say, is Mama, on your side about this one? Is this good or bad? Good movement, bad movement, improvement or decline?
It's good. Yeah, I think it's good.
Why are we saying that?
Because it increased from 0.1 to 0.8, but like it's not like increase in Ulu, because it's not that much of an increase. But like, yeah, it's a good increase because now for every 1 rand they have like 0.8 cents instead of the 0.1.
Yeah, that's very good. It's still an improvement, although it's not enough, right? But also remember that acid test ratio is we excluded what? We excluded the what is the benchmark for acid test ratio? Do you still remember what is the benchmark for that? The benchmark for acid test ratio is actually 1:1, right? For current ratio is 2:1. That is a benchmark. For acid test ratio, you must remember that it excludes inventory, right? Although like we still unable to meet our short-term obligations without relying on inventory, but there is an improvement as compared to previous year. Probably in 2026, we'll be even in a better position because we're almost there. You can see there that there was a huge improvement, although it's still not enough, but there was a huge improvement on the acid test ratio. Okay. Debtors collection period, it moved from 43 days to 36 days. You guys can see this one is an improvement, obviously. Creditors payment period, this one, there was no movement. You can see the solvency ratio, it moved from 2.6:1 to 2.2:1. What can you guys say about the solvency ratio? Improvement or not?
Could it be both, like an improvement that's not too many current assets? Is it? No, I don't think so. I think it will be a decline.
It is a decline, yeah?
Yeah.
Yes, it is a decline, exactly. Because remember, solvency ratio, we said we're comparing what? We said we're comparing total assets to total liability. That's what we spoke
Yeah.
about. So now, in this scenario, it means although we are still able to cover our liabilities using our assets, yeah? But there is a decline, which is it's a bad trend, right? It's a declining trend, which is not something we're happy about. We need to be careful now when it comes to solvency ratio, because what if next year we're having something about 1.9 is to 1, or maybe it keeps on going down, right? It keeps on declining up until it is less than the liability. Then it becomes a problem. Debt equity ratio, 0.5 is to 1, 0.8 is to 1. What about this one? Is this one an improvement or a decline? Are we happy about a debt equity ratio if it moves like this or not?
Yes.
Yes, why are we saying we're happy?
It improved from 0.5 to 0.8.
Okay, why are we saying it improved?
Because it went higher. It's closer to being 1-to-1.
I understand that, but what does it actually mean? What does it actually mean?
No, I think it's highly geared.
Highly geared, no?
Yeah. I think I misinterpreted it, but
So is this something we should be happy about or not be happy about as a business?
not be happy.
Exactly, that's correct. We should not be happy about this one, right? It's not an improvement, this one, right? Instead, it's a burden to us as a company. It shows now that, remember, a debt equity ratio, right? Debt equity ratio, what does the formula say it's for a debt equity ratio? It is actually like we're comparing our debt to, like we're actually comparing our debt to what? To the equity, right? That is our debt equity ratio. It is actually total debt is to total equity, right? Debt equity ratio. We are comparing, it's like total debt is to total equity. So at all times, we always want to have equity that is more than our debt. If I have 500,000 as my debt, I need to have 2 million. For example, as what? I need to have 2 million as my equity, right? Or else, if my ratio is 1, maybe this side is 2. I think it's a good thing for the business, right? It's a good thing for the business because we only have half of our total. Okay, half of our total capital is debt, and then the other one is equity. We always want to have more equity than a debt, right? Looking at this one, we do have more. This side, we do have more equity than debt because we have one equity of 0.5 debt. But the direction it goes here, it is still in a good position, but okay, debt is still less than the equity. But the way it is increasing, which means now we are starting to rely more on debt. We're starting to borrow more money, which is not the right thing. It's not the right movement for the business. Because if our debt was 0.5 and it is now 0.8, we're starting to rely more on debt. It's not a good movement for the business. We are exposed now. They're going to charge us interest with this debt that is increasing because we're borrowing more loans here. We're taking mortgage loans. That's why 0.5 increased to 0.8. You see, which is not something we should be happy about as what? As shareholders of the company or as directors of the company, right? Because we will end up now having 1:1. which is now starting to be bad. You will remember there was a question there that said, would you advise, right? They said here, the directors of the company want to expand the business by opening more branches in other provinces. Explain why you would recommend that they should not borrow more money. Can you see this question? Where is it going to? Code 2 financial indicators with figures. Why? Explain why you will recommend that they should not borrow more money. I would recommend they should not, because if they borrow more money, now they're gonna move to about 0.9:1, or 1:1, or 1.2:1. It's possible, depending on how much they're borrowing, because you can see debt is increasing. It was 0.5, now it is 0.8. If they can borrow even more money now to do that expansion they're talking about, what is going to be a debt equity ratio? It's gonna go up maybe to 1. What if it goes to 1.3:1? What if it goes to 1.3:1? Are we still going to be happy about this as a company? No, because now debt is becoming more than an equity, which is a problem for the business. We are in a risk now of being charged the interest. And we're going to have to do more monthly repayments, which is straining the cash flow of the business, you see. So those are issues that we should be thinking about, guys. Those are the things that we should be thinking about. It is not advisable, right? It is not advisable for the company to say, it is not advisable for the company to say they must borrow more money. No. Because already we are already relying more on debt. Even now, you can see with that the movement of this ratio starting to rely more on debt, on borrowings, which is not something we're happy about, right? So we need to be careful of that. Okay, we're just going through like the high level review, guys. We're just discussing the ratios based on our understanding, which is something I'm trying to show you things you should be thinking about while you're reading your scenario. You can see already by discussing this debt equity ratio, we have already like answered a question like this, right? We have already answered a question like this, right? Because we know very well debt equity ratio is one of the ratio that we're going to quote here. Why would you recommend that they should not borrow more money? Already we know why they should not. Because already like their debt equity ratio is moving in a bad direction. If they borrow more money, it's gonna be worse now and it becomes a problem for the company. Okay. Let's carry on. Return on average capital employed, 9.5% in the previous year. Now it is 8.2, right? It was 9.5. Now it is 8.2. Okay. The return is decreasing, the return is going down. Looking at this, right? And also what is more important, this one should be compared. The return on total, on average capital employed should always be compared with the interest on loan. If you look here, we do have an interest on loan, right? We do have an interest on loan. If you look at this return, how many percent do we have? You see how many percent do we have? Like our return is 9.5, but the interest that they're charging us on the loan is 12%. We're paying more than what we're getting. You see, we borrowed money to generate income, but we're only generating 9.5%. But how much we're paying back as interest is 12%. This is not a good thing for a business. Same thing with this one. This one is even declined. The return is declining, but the interest remains the same. It remains 12%, which means now with the business is getting more strained financially. Like there will be more cash outflow here because we're getting less money, but we're paying more on interest. Like, just imagine this thing, guys. I want to show you a scenario here. Like if you borrow 100 rand, right? If you borrow 100 rand to invest and make money, right? If you borrow 100 rand, to put in your business. Maybe that 100 rand helps you to generate maybe 10% of it. If you generate 10% of this 100 rand as income, so 10% of this 100 rand becomes what? Income. And then how much will be that income? If I say 100 times 10%, how much am I going to get? I'm getting 10 rand, right? But now, because you borrowed this money, because you borrowed this 100 rand, and then they're charging you 12%. They're charging you 12% interest. You see, with this 100 rand, you're only generating 10% income, which is 10 rand. But how much are you paying? You're paying 12% interest. So now, if you're saying 100 times the 12%, you see now that you're paying more than what you're generating. You're generating 10 rand, but you're paying 12 rand as what? As an interest. Then how much will be, you see you're making a loss. And you see you're making a loss here. You're making a loss of 2 rands. So it's not a good thing for a business. If you analyze what is happening here, you're generating 9.5 for the monies that you borrowed. Because remember, the return on average capital employed. When we're talking about the capital employed, we're talking about both equity and we're talking about both equity and what? If you remember the formula, it says net profit before tax and interest expense, right? Over average shareholders equity plus what? Plus the loans plus the capital, which is like we're talking about the interest, the loan, sorry. We're talking about what? We're talking about the loans, which is average total capital employed. When we talk about average total capital employed, there we're talking about shareholders equity plus borrowings, which is the non-current liabilities. So the return from there is less than the expense that we're incurring, which is a problem for the business. Okay, I was just giving you a high-level review, guys, on this thing, which is going to help us when we start answering the questions. Okay. Return on average shareholders equity. You can see that shareholders equity, the return is going down from 6.2 to 4.5. We're not happy about this as a business. We're really not happy. Earnings per share, 58 cents. Okay, let's talk about this one. Earnings per share, 58 cents in the previous year, 51 cents in the current year. Should I be happy about this one?
No.
Why I should not be happy?
The earnings decreased.
Exactly, the earnings are decreasing, right? Earnings per share, they are decreasing, which means now the investment of the shareholders is not getting the returns, is not getting the earning that shareholders they are expecting. Because if a shareholder is earning 58 cents on one share, now the shareholder is earning 51 cents. Shareholders will not be happy about this. They will not be happy about this earnings per share. They will not be happy. So things are declining in this company. There's less improvement, but things are declining. You can see there was even that question that asked you, should we keep this CFO if things are going like this in this business? Would you keep the CFO if things are like this?
No.
I'm just asking. Yes, why are you keeping a CFO when you're not happy about the financial matters of the? Because remember, these numbers, they're indicating the financial matters of this company. What is happening in terms of the income statement, the balance sheet, the cash flow movement of the business. So dividends per share, it was 35 cents in the previous year. Now it is 55 cents. You can see now the share has earned less, but they pay more dividends, right? There was increase in dividends per share. Of which shareholders, they will be happy, obviously. But now, is it going to be possible for that expansion they were talking about? if you're paying 55 cents, but you only earned 51 cents. Now, they're talking about what? They're talking about improving or expanding. If you pay your dividends more than what the share has earned, you see now the dividend payout rate here. Dividends payout rate, it was 60.3 in the previous year. Now it's they did ask us a question like this. Dividends payout rate will be calculated based on these two numbers. You can see here we have 60.3. So which means now 60.3 of the earnings is paid to shareholders as a dividend. 60.3% of the earnings. That 60.3 is 35 over 58 times 100. Can you guys punch the calculator? 35 divided by 68. Oh, sorry, divided by 58 times 100. How much are you getting there?
63.64%.
63.64.
64. Yeah.
I'm getting 60.34. 35 over 58. 35 over 58 times 100.
Yeah, I'm getting 60.34 now.
So that is a dividend payout rate for the previous year, which means you can calculate a dividend payout rate for the current year. How are you going to get it? Can you see this, man? What we're talking about here?
Yeah, in Gabon.
Okay, so how are we going to get a dividend payout rate for the current financial year? Say, following the same principle that we did in 2024. If we say 55 divided by 51, and at this side we said 35 divided by 58. So this side we need to say 55 divided by 51 multiplied by 100. What is the percentage we're getting here?
107.8.
107.8. Yes, definitely 107.8. It is going to be our 107.8%. It is going to be our dividend payout rate for 2025. They did ask us a question about that. Like there was a question that was asking you to calculate a dividend payout rate. I'm not sure which question was that. There is it. Calculate dividend payout rate for the year ended 25th February 2025. Is 2 marks, free 2 marks to calculate, right? So, and then explain why directors decided to change. You can see now what is happening here. We're just analyzing the information provided, but from that information, we can see that most of the questions that they were asking, we are able to answer them now while we're analyzing the information. Net asset value per share, you can see it was 1,060 cents. Now it is 1,025. You see the value of the shares is going down. It was 1,060 cents. Now it goes down to 1,025 cents. We should not be happy about something like this, right? The value of the shares is going down. Shareholders will not be happy about this, and they will not be interested to invest. Even for us, it's not easy for this business to get more other investors. No shareholders will come and buy shares in this company. Next year, they will not come unless they are motivated by this. Unless they are motivated by this dividends per share. You see this dividends per share? Obviously, this one is good for, it is good for shareholders. This one, it is good for shareholders, this dividends per share. They will be happy, right? But for the company expansion, it makes it impossible because now, if you're earning 51 cents and you pay 55, where is the 4%, the extra 4? Where did you get the extra 4 cents? It is definitely coming from the reserves, which is the retained income. Because you cannot earn 51 and you pay 55. What kind of a business is that? It is earning 51 cents, but they're paying 55 cents to the shareholders as dividends. Definitely the 4 cents difference, they got it from retained income. And we know very well that retained income is for future expansion of the business. So now, how are we going to expand if we're taking money and pay to shareholders? It's a very wrong decision. There is decisions that are happening here. Additional information, market price per share. We can see there. Another thing you can see here, market price per share, 1,030. You see, 1,030 cents per share. And then in the current year is what? Is 1,000 cents per share. Which is, although the difference, the value, look, the value of the share is 1,025, right? But the market share price is 1,000 cents. And then in the previous year, it was 1,030 cents. Comparing with the value of our shares, although our shares are still valued above, you can see they're still valued above the market share price, right? Of which you can even see no one will be interested to buy our shares because this is what the market is paying. But if our shares are valued at this amount, they will need to go down further, which will still be negative, not a good thing for the business, right? Not a good thing. Even like it is now going down in the current year. It was 1,030 in the previous year. Interest on loans, 12%, it remained the same. Interest on investment, it remained the same. Okay. But now look at the return on average shareholders' equity. Look. Their return is 6.2. But interest on investment is 7%. Which means if I take my money, invest it in the bank, I'm going to get 7%. But I invested in this company. What kind of a company is this? They said it is Venus Ltd or what? Venus Ltd. If you look at this company here, what is happening? The return is 6.2%. But in the investment in the bank is 7%. I'll rather take my money and invest it in the bank so that I can get more than what the aim of investing in the company is so that I can get more return as a shareholder. But if I still get less than what is the bank can give me, why am I not taking my money straight to the bank? It even declined to 4.5% in the current year, but the bank remains 7%. Why am I not taking my money, put it in the bank, and then I get it with a 7% interest instead of buying shares in this company where the return is very low? You see, these are things that we should be thinking about. Shares of Venus Ltd. Let's look at this one. In issue on 20 February 2024, we have 900,000 shares. On 28 February 2025, 950. So these are the shares in issue at the beginning. These are the shares at the end. And then new shares issued on 31 July 2024, 10 Rand 50 each. We have 125,000 shares. Repurchased on 1 December 2024, 12 Rand each. That is 75,000 shares. Then we have a shareholding of Denzel Cross in Venus Ltd. Percentage shareholding on 29 February 2024. That was 45%. And the number of shares owned on 28 February 2025. That is 494,000 rand. If you remember there was a question that they were asking us to calculate the shareholding, something like that. Calculate the number of new shares that Denzel purchased on 31 July 2024. You see, there is a question like that because if you look here, we do have a number of shares owned on 20 February 2025. But now, in 2024, we don't have a number. Instead, we have a percentage. So, and we know very well how many shares were there in 2024. There was 900,000 shares. If you say 900,000 times 45%, how many shares you getting? 900,000 multiplied by 45. What do you get there as the number of shares? 900,000 multiplied by 45%. How many shares are we getting?
I got 405,000 shares.
405,000 shares. Okay, 405,000 shares. So which means now, this guy who is which guy is this one? Shares of Venus Ltd. Denzel Cross was owning 405,000 shares in 2020, in 2024, but now in 2025, these are the number of shares he's owning in 2024. Then in 2025, there's 494,000 rand. Okay, 494,000 rand in 2020, in 2025. So which means now this guy purchased more shares. He's owning more than the shares that he was owning. So how many shares did he buy? He bought 89,000 more, right? There was a question that was asking us how many shares did calculate the number of new shares that Denzel purchased on 31 July 2024, which is 89,000 extra shares were purchased because you're looking at 494 minus 405, and then you get the shares that's were purchased. Guys, you can see here what the only thing we did here was to analyze the question. We did not answer any question, but what we did was to analyze the question that is provided to us. So now I want to meet with you tomorrow morning, 8 o'clock. Are you guys available?
I to 11.